In late 2022, Solana was trading below $10. Developer confidence had collapsed, and multiple high-profile applications exited the ecosystem. Repeated network outages raised concerns about reliability, while the sudden failure of FTX created deep uncertainty around Solana's future. At that time, Solana's total value locked fell by more than 90%. By January 2026, the network has completed one of the strongest recoveries in the crypto industry, re-establishing itself as one of the most active smart contract platforms in the market. Welcome to the Crypto IQ. Today we're examining Solana's post-crisis recovery, breaking down the technical upgrades that stabilized the network, analyzing how consumer applications and decentralized finance fueled renewed growth, and evaluating whether Solana's speed and user experience advantages can sustain long-term momentum, or whether structural centralization risks could ultimately limit its upside. Solana's architecture and early design choices. Solana launched in 2020 with a design focused on high throughput and low transaction costs. The network combines proof of stake with a cryptographic sequencing mechanism known as proof of history. This system time-stamps transactions before consensus, reducing coordination overhead and enabling rapid block production. By late 2025, Solana consistently processed tens of thousands of transactions per second under live network conditions, placing it among the highest throughput blockchains in operation. These design choices allowed Solana to prioritize execution speed and low fees without relying on secondary scaling layers. However, the same design also increased hardware requirements for validators, a trade-off that would later raise decentralization concerns. The FTX collapse and ecosystem damage. The collapse of FTX in November 2022 had an outsized impact on Solana compared to other ecosystems. Alameda Research served as a major liquidity provider for SOL markets, and FTX maintained deep operational ties with early Solana projects. Following the collapse, SOL prices declined sharply, ecosystem funds became insolvent, and developer sentiment deteriorated. Despite this damage, the Solana blockchain itself continued producing blocks and avoided a full network halt. Recovery through execution, not narrative. Throughout 2023, Solana's core development teams continued shipping protocol upgrades. Validators remained online, network performance gradually improved. By mid-2023, early signs of recovery emerged as new applications launched and on-chain activity stabilized. That recovery accelerated through 2024 and into 2025 as usage expanded across decentralized exchanges, NFTs, gaming, and consumer applications. Unlike earlier growth phases driven by speculation, this recovery was reflected in sustained transaction volume rather than short-lived spikes. Consumer applications drive usage. One of the most important drivers of Solana's resurgence was consumer-facing applications. Solana's transaction fees, typically measured in fractions of a cent, enabled frequent on-chain interactions that would be impractical on higher-cost networks. This allowed applications centered on social interaction, payments, gaming, and high-frequency trading to scale to large user bases. Wallet interfaces improved alongside application growth, making Solana easier to use for non-technical users and mobile-first audiences. Decentralized exchanges and market activity. Decentralized exchanges on Solana experienced sustained growth during 2024 and 2025. Both automated market makers and central limit order book designs benefited from fast block times and low latency. This enabled real-time trading strategies and higher capital efficiency. During peak periods, Solana-based exchanges recorded daily volumes comparable to older, more established networks. This activity contributed to consistent fee generation and deeper liquidity across the ecosystem. NFTs, gaming, and compressed assets. Non-fungible token activity rebounded as well. Solana NFT marketplaces processed millions of daily interactions during high-traffic periods. The introduction of compressed NFTs reduced storage costs dramatically, enabling large-scale minting for gaming assets, loyalty programs, and digital identity use cases. Gaming became a major growth area. Several Solana-based games reached hundreds of thousands of daily active users by late 2025, relying on near-instant transaction confirmation and predictable fees to function effectively. Developer growth and tooling maturity. Developer activity followed user growth. By late 2025, Solana ranked among the top blockchain ecosystems by monthly active developers. Tooling matured significantly. SDKs stabilized, documentation expanded, and testing environments improved. These changes reduced development friction and supported more complex consumer-facing applications. Firedancer and network reliability. A major technical milestone was the development of Firedancer, an independent validator client designed to improve performance, resilience, and client diversity. Developed separately from the original Solana Labs client, Firedancer completed multiple testnet phases by late 2025 and demonstrated significantly higher throughput under stress conditions. Client diversity addresses a long-standing risk. Historically, most Solana validators relied on a single software implementation, increasing systemic vulnerability. Firedancer reduces that risk by introducing an alternative codebase. Network reliability improved alongside these efforts. While minor disruptions still occurred, large-scale outages became less frequent compared to earlier years. Protocol updates focused on congestion control, fee markets, and transaction prioritization improved performance during demand spikes. Institutional interest returns. As stability improved, institutional interest returned. During 2024 and 2025, multiple Solana-linked investment products launched outside the United States. Custodial infrastructure expanded. Trading desks increased SOL liquidity. Derivatives markets matured on regulated venues, improving price discovery and risk management. DeFi expansion and staking economics. Decentralized finance on Solana diversified beyond early experiments. Lending protocols, liquid staking platforms, and derivatives markets grew steadily. Liquid staking tokens allowed users to earn staking rewards while retaining liquidity, increasing capital efficiency across the ecosystem. Staking participation remained high. A significant portion of SOL supply was staked, contributing to network security. Validator counts increased, though hardware requirements remained substantial, reinforcing concerns around accessibility. Centralization and governance. Risks. Hardware intensity remains one of the most persistent centralization concerns within the Solana network. Operating a Solana validator requires high-performance servers, fast processors, large memory capacity, and strong, stable network connectivity. These requirements increase operating costs and raise the barrier to entry compared with many other proof-of-stake networks. As a result, validators tend to cluster in regions with advanced data center infrastructure and lower latency access, which can limit geographic distribution and reduce resilience against regional outages or regulatory disruptions. The 2026 test. By January 2026, Solana occupies a materially different position than during its early hype cycle or post-collapse phase. It is now evaluated primarily on measurable performance metrics, including throughput, network reliability, developer activity, and sustained user demand across real applications rather than speculative narratives. Whether Solana evolves into a long-term crypto powerhouse depends on execution under higher expectations. The technology is in place, usage is established, institutional interest has returned. The coming phase will test whether these elements can scale together while addressing centralization pressures without sacrificing performance. Subscribe to the Crypto IQ, as we will come back again with another interesting topic.